Most traders know what supply and demand are. The problem is they don't know which zones actually matter. They draw triangles everywhere, the market pauses, and they wait for price to enter their zone so as they can enter a trade. They end up getting stopped out immediately. So in this video, I am going to show you a much simpler way to look at supply and demand. We will cover what supply and demand actually are, how to identify a quality zone, the biggest mistake beginners make, and finally, how we can combine supply and demand with market structure and liquidity. Let's start with the basics. What is demand? Demand is simply an area where buying pressure becomes strong enough to push the market higher. Let's look at this from a textbook perspective. We have a bullish structure. After a pullback, the market entered into a period of indecision. You look at the equal highs and the equal lows. This resulted into consolidation. So during this consolidation, buyers and sellers are fighting. There is a war between buyers and sellers fighting. So eventually, the buyers won the war and they pushed price to the upside aggressively. So when they push price to the upside aggressively, they leave behind an imbalance or a fair value gap. So the region that pushed price to the upside is what we consider as a demand zone. So the region where the consolidation happened and pushed the price to upside, that means the buyers won the war. So the war is between the buyers and the sellers. So when the buyers win the war, they push price to the upside, leaving behind a fair value gap and an imbalance. Traders anticipate that there is a potential pullback to the demand zone before price can push again to the upside. So there is a reaction here before price continues to the upside. That's what we call a demand zone. The simplest way I can define a demand zone is you look at the consolidation here and the displacement. So when you look at the consolidation and the displacement, so let me call this the base, and this one, the displacement. So when you're looking for a demand zone, you look at the consolidation. Let me call it the base that caused the displacement. So the base that caused the displacement is the demand zone. So you look at the base that caused the displacement. That is our demand zone. That is the simplest way I can explain a demand zone. Let me repeat this. You look for the base that caused a displacement. What makes a displacement? A displacement contains an imbalance or a fair value gap. As we continue into the charts, we shall look at the fair value gap and the imbalances I'm talking about. Let's look at the charts. When you look at the charts here, you look at this indecision. These are three bullish candles, then a pullback, then buyers entered the market, sellers entered the market once more. So there is a fight, there is a war between the buyers and the sellers. Here, the buyers push the market and the sellers aggressively push the market down. So there is an indecision here before an aggressive move to the upside. So before the bulls pushed the market to the upside, there was an indecision here. So we mark this as a demand zone. Why? Because there was a fight between the buyers and the sellers, but the buyers won and pushed the price to the upside. When the buyers win, we mark this as a demand zone. This is the imbalance I was talking about. When you look at the first candle and the second candle and the third candle, at the opening of the third candle, there is a space, a blank space here. You know, this space here. You know, I want you to look at these three candles, this one and this one and this one. When you look at the closure here and the open of this candle, you see there is no space between this middle candle here. But when you look at this 1, 2, 3, and you look at the middle candle of this space, the middle candle, when you look at the middle of this candle, you see that there is space here. So this is what we call an efficiency or an imbalance. Other traders call it a fair value gap. So this is the imbalance I'm talking about. So when you look at this, you mark this as a demand zone. So the idea is that there will be a potential pullback to this zone before the market
continues to move to the upside. So when you mark this zone here with the wicks like this, with the wicks like that, so we anticipate that price might come back to this zone before it pushes to the upside. So let us see what really happened. As you look at the charts, price made a pullback and pulled back to this zone, this demand zone, and then pushed to the upside. So this is our demand zone. So this is the displacement I was talking about. The market moves to fill imbalances. So let us look at this second example. So when you look at the chart here, you can see that the market is moving sideways. Here, you can see a bearish candle, a bearish second candle, a bearish third candle. Then, there's a war here before this displacement here, leaving a fair value gap or an efficiency or an imbalance, whatever you may call it. As I told you in the first example, you mark this as a demand zone. After marking this demand zone, then we believe that the market has to move back to fill these imbalances, these fair value gaps, these efficiency zones, before it can move to the upside. So let us play price and see what happened. We have completed demand zones. This has to be noted. A demand zone doesn't mean that price must go up from here. It simply tells us this is an area where buyers previously showed interest. We should consider demand zones as areas of interest, not a must enter trade zone. To check for other confluences like break of structure, liquidity sweeps, to confirm or to enter an A plus trade. So we shouldn't use demand zones as a must enter trade. No, we should look for other confluences so as to take good trades. Now let us flip the idea. What is a supply zone? The supply zone is an area where selling pressure became strong enough to push price lower. So let us look at the textbook version of supply. When you look at the price now, it is pushing to the downwards. Then it makes a pullback, and then making a consolidation, indecision of the market, the equal highs and equal lows, then a displacement to the downside. That the market has to come back to supply before it can move downwards. Why? Because at the displacement here, it leaves efficiency or imbalances or fair value gaps. Price has to make a pullback into this zone and then it rallies down. So we call this a supply zone. Why? During this indecision, the sellers pushed price to the downside. Price has to come back to the supply zone to fill the orders that were left out and to fill these imbalances here before it rallies to the downside. So how do we enter our trade here? We do this. We target this low and our entry is exactly on this demand zone, on this supply zone. Our stop loss is slightly above the wicks of the indecision. This is the textbook version of supply. Let us run to the charts. Let us look at the charts. When you look at the charts, you look at this consolidation or sideways movement, the one that caused displacement to the downside, leaving behind fair value gaps. So as I told you, we mark the region that caused the displacement. We call this the supply zone. Why do we call it the supply zone? The supply zone is a region that caused the displacement to the downside. And as traders, we believe that the market will return back to this region, one, to fill the imbalances left behind, two, there are some orders that have been left out that will be picked from this region before price rallies to the downside. let's look at this second example. When you look at price on this chart, you look at this sideways movement, the consolidation here, before this displacement. We look for the region that caused a displacement and mark the region as a supply zone. As traders, we hope that price has to return back to this zone to fill the imbalances and to pick the left orders before it can rally to the downside. What makes a demand zone a strong zone to consider, or a zone to consider to enter for a strong A+ setup? When you look at the market now, it is moving upside. Then it pulls back and makes a consolidation. After this consolidation, we see a pullback. We call this a liquidity sweep or a fake out, then a displacement. This displacement caused a break of structure. If you don't know a break of structure, you'll check my next video, because I'm going to make a video about market structure. It will be my next video. So this displacement caused a break of structure. So when a demand zone causes a break of structure, then we get to know that the buyers who have entered this market are too strong to an extent of breaking the previous high. So when you look at all these conferences, a liquidity sweep and a break of structure, you consider this as a strong zone for a potential reaction when price comes back to this zone. Let us look at this possible trade setup. When you look at the market structure, you look at this high, and this is the low of the other high. So when you look at it, this displacement block structure. So as I had told you, when you see a displacement that breaks structure, then the supply here is a strong supply that we can give melt to consider a possible trade or an A+ setup. So how do we enter our trade? I enjoy a risk reward of 3-to-1. So if a trade does not match or does not give me a 3-to-1 risk to reward, I normally ignore that trade. I put my entry and my stop loss. I put my entry at the low of the supply zone, a bit low, so as I don't miss a trade, and the stop loss slightly higher than where I marked my supply zone, and I target So let us look at this last example. When you look at market structure here, you look at this high and you look at the low here. When we look at that, you immediately tell me that this is a break of structure. So after seeing this break of structure, there's a sweep of liquidity here. These lows and these lows, there's a sweep of liquidity. Liquidity is always at the lows. So we mark this as a liquidity sweep. So when we look at these three confluences, we're looking at demand here, we're looking at a break of structure, this displacement, and we're looking at a liquidity sweep. Liquidity was at the bottom of these lows, was swept by this week. Then we look at this demand zone as a strong zone to consider for our entry, looking for a 3-to-1 risk to reward.